This is going to be a stock analysis for Natwest Group. Before I start, please remember I just do these videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. So Natwest Group is the UK's fourth largest bank with about 19 million customers. It has systemically important institution status and is currently paying out 5% dividend plus 2 billions of buybacks for the last 4 years running. And they have a policy of returning 40% of its profits to shareholders. Now, they are tarnished with a reputation for political activism, and I'll get into that later. But the government ownership has reduced drastically. Following the great financial crisis, they were actually 84% owned by the government. However, that's reduced substantially, and only last week there was an announcement that His Majesty's Treasury now only owns 10% of the bank. You can see they've got a really nice looking net income trend over the last 4 years, and their capital ratios are looking very solid. 4% of their profit comes from their private banking arm, which is Coutts, and then 38% of their profit comes from the retail banking, with 58% from commercial and institutional banking. This is actually quite a large contribution, quite a bit more than most of the other banks, and this is definitely a positive for NatWest. The retail banking is basically people just using it for normal banking for their mortgages and credit cards and personal loans and overdrafts, whereas the commercial banking supports SME businesses, business loans and working capital for larger companies, and includes corporate and institutional banking. The private banking is all done under the Coutts Private Bank, whereas the retail and commercial are done through the NatWest, Royal Bank of Scotland, and Ulster Bank brands. NatWest has quite an interesting history, which can be traced back to 1658, where we had the Smiths Bank in Nottingham, which was the first ever provincial bank in the UK. And that's actually still, even now, a NatWest branch. The Smiths Bank got took over by National Provincial Bank in 1918, who took over Coutts in 1920. Then there was a merger with District Bank, who then also amalgamated with Westminster Bank in 1970, forming the familiar National Westminster Bank brand. Incidentally, these three arrows are actually represent arrowheads. Then in the year 2000, the Royal Bank of Scotland bought National Westminster Bank, forming RBS, and they did that at a cost of 21 billion. However, when we had the great financial crisis, this resulted in Her Majesty's Treasury acquiring 84% of the bank as part of the bailouts at a cost to the taxpayer of 46 billion. A lot of the dodgier parts of the bank were the RBS, were the Royal Bank of Scotland side, and there were lots of divestments then following this. And then in 2020, the company rebranded as NatWest, with the ticker symbol changing from RBS to NWG.L. Then following 2020, the banks actually started growing again. It bought Ulster Bank in 2021, and then only this year they've bought Sainsbury's Bank. So looking at the capital ratios, these are a ratio of the what are considered the bank's good equity, so things like retained earnings and reserves and paid up capital, as a proportion of the overall equity of the company. Following Basel, the banks have to keep to certain capital ratios, and the specification is actually about 6% for CET1, so they're well above the minimum requirements, and they've got a target of keeping it between 13 and 14%. Well, they're currently at 13.9%. So they're in a good position here. It has to be said though that this to me is a bit of an abstract way of valuing how creditworthy a bank is. I find looking at equity very kind of difficult to kind of conceptualize. This being perhaps the most important metric it's doing very well in. With banks, you've got to consider the risk is that they are inherently difficult to understand. Looking at their income, you can see the as you'd expect from here, the private banking is only a very small part of the pie, and their operating profit is dominated by their retail and commercial. And we have a trend of, whereas retail's been struggling a bit the last few years, the commercial is doing great. Here I've got a breakdown of their income and expenditure. And for a bank, the main line items for income are the net interest income, and then also they have fees and trading income. And you can see that compared with back in the Wild West days, where their income was all kinds of other things which were kind of risky and difficult to understand. Now it's a lot cleaner. It's mostly net interest income, and there's a nice trend here. So we do see that when we compare pre-credit crunch to now, they're looking a lot more solid, really, as an investment proposition. And the same for expenditure. It's mainly staff costs and premises and equipment and other admin expenses. And there's a nice kind of trend here with staff costs and premises actually dominating the total amount. So it's a lot more stable a situation as back in the Wild West days. And notably, you can see the large spike in impairments following the credit crunch. So this highlights really my main reason why I'm interested in looking at banks, is that when you look at the sector graph here, see how this is how banks used to be valued. Then obviously they became very unfashionable. Situation around the banks is a lot more favourable now. And so I think they should be getting priced more appropriately. I still think like they're being priced like they were the risky things they were back here. You get the same pattern whichever bank you look at, exactly as per the sector chart. For NatWest, this is how they used to be priced. And then for the last decade, really, they've been in the doldrums here. But I noticed this technical pattern. I think that there's an argument that banks as a sector are going to come back in fashion again. And we've kind of seen this technically here already. And as I'm about to go into, a lot of it comes down to actually bond yields, particularly the slope of the yield curve, and also so particularly 10-year bonds. And historically, as you can see here, back in the previous glory days, they were really high. Then they dropped massively, and you can see the whole sector dropped. But now they are kind of high again. And so my kind of main hypothesis here is that just as 10-year bond yields are high, I think that the sector is going to become fashionable again, and there could be some good money to be made here. The actual sector is currently in this channel, having broken out of this asymmetric triangle, which you can see with NatWest, and this trend is mirrored in all the other banking stocks I've looked at. So I've determined that the way a bank makes money can be actually broken down to the size of its loan book, how much money is it lending, times its NIM, which is net interest margin. And then you add to that the fees and other income. So the loan book, which you see in their assets as their loans to customers plus cash held at central banks, that multiplied by their NIM, or net interest margin, very approximately gives you their net interest income. And then on top of that, you add the fees and trading income. And I've actually been tracking these metrics, see how following the increase in interest rates, actually base rates, but then also on the longer end, we saw the net interest margin increase. But actually, even historically going back, it doesn't actually change all that much. So in a crisis, it might be, say, 1.8%, but it never seems to generally increase much to above perhaps, and it tops perhaps about 3%. But that can then affect, just that 1% change can lead to a big change in the overall net interest income, because that number is multiplied by the total loan book. But actually the short end or the base rates have an effect as well, because when you have higher interest rates, people tend to take out less loans, which lowers the loan book, and then they shift money into high interest paying savings accounts, which actually is bad for the banks. It actually lowers their NIM. So we seem to have had actually a bit of these are the average base rates, and there seems to have been a lag effect where the NIM jumped up initially, but then as more people stopped borrowing and started saving, then we see actually this year the NIM's dropped. But really, my base case for investing in banks is that next year they're going to drop at the lower rate. At the higher rate, at 10 years and longer, the yield curve will stay elevated, mainly because of the fiscal indiscipline of the government. And if you go into my YouTube channel, there's a few videos, particularly these two, on the FTSE and the S&P 500, where I go into that in more detail. And when we look at the actual annual report, they do specify particularly yield curve movements as the main reason why they made more money in 2023 versus 2022. They even provide an analysis of assuming a parallel increase in the yield curve, how much money they're going to make or lose depending on interest rates go up or down. But that is actually assuming a parallel rate, and I think there's also an effect of the steepening of the curve as well. And so my base case for investing in banks is we're going to have a normalization of the yield curve, lower at the short end, higher at the long end, and this will lead to a larger loan book and a higher NIM. And so I'm going to be tracking the bond yields, and here you can see how compared with the beginning of 2023, we've seen it increase on the long end and it's starting to drop at the short end. But the general higher short ends then impacted their NIM in a bad way. And what you see in the difference between, but you see how during the course of 2023 was when they made loads of money. That was because at the high end particularly, it shot up dramatically, which was a great boost to their NIM. But then the lag-on effects of the higher short end is affecting them badly this year. But I'm hoping that next year they're going to lower rates at the low end, maybe only down to say 3% or something. But because of the fiscal indiscipline, it will remain high on the long end. And so I'm going to be looking for the normalization of this curve. And then, of course, the key thing when I think back to the sector pattern that I'm hunting, I'm hoping to see that the 10-year bond yields stay high up here, and so then we kind of return to the good old times in terms of the sector chart and in the valuation the market gives to the banking sector. Now, regarding these cause and effects I've gone into, I kind of did double check my theory with the help of Grok. You can print screen and have a look at that independent analysis if you like. Okay, so on to assets and liabilities. Most of the assets of NatWest and any bank are their loans to customers. These are literally where the bank has printed money out of thin air just by typing it into a computer screen and then lent people money so they can go and get a mortgage or go on a holiday on their credit card or something. So this is the magic of banks, is that they're the one asset class, they're the one kind of business that's able to just print money out of thin air, thanks to the magic of having a banking license, and make it an asset for themselves. And so most of their assets are actually loaned customers, but they also do have assets which are held at central banks. Now, on the liabilities side, these are actually mostly people's customers' deposits. So obviously, because the pound sterling is legal tender in the UK, the banks have a captive audience because the whole population is forced to do everything, get paid, spend money, pay for things using pound sterling, and they have to use the banks really to do that. So each bank's got a captive audience of customers, and so all their customer deposits. Now, actually, the majority of these are not paying any interest, but I've found out that 11% are. When I last checked, they pay out 6% to balances below 5,000 and a paltry 1.5% to balances larger than that. So overall, it's actually a very low interest that they're paying out. And this includes, of course, corporations and businesses that have a banking account as well. What happens is, on the asset side, the people who borrowed a mortgage or took out on a credit card, they pay varying interest as well. And so the difference between this low interest that they have on their deposits and these higher interests on where they've loaned people money, that difference in interest rates, that's how you get the NIM. And so here, from looking at the liabilities and assets of the bank, you really do get a great kind of understanding of the basics of how a bank operates. Within these loans to customers, over half is actually mortgages, and so that gives you an insight into the importance of the housing market to the UK economy. And then commercial is a big chunk, as it's institutional. Interestingly, credit cards are only a tiny slice of the pie, much to my disappointment. And in terms of deposits, again, half of it's personal and about 35% corporate. Now, a important metric is credit risk, and they use this stage 3 metric, which is all the loans which are fairly pretty much gone bad, and they've written off practically. I've used 2019 as a good reference year before the world started getting silly, and I've got that against the 2024 Q3 data. We see that overall, actually, there's a drop in risk from 1.9% to 1.5%. And mortgages back in 2019, 2% was stage 3, whereas now it's only 1%. Commercial real estate dropped from 3 to 2%. Commercial was stayed at 2%, and institutional 0%. So according to these credit risk metrics, everything looks solid. Another way of looking at it is percentage of loans which are over 30 days their due date. First of all, you get a nice appreciation of the kind of stability of the proportions of these different parts of the loan book. Kind of a bit suspiciously, they used to do kind of a commercial real estate. I mean, they called it property, but I'm assuming that means commercial real estate. That used to be dealt with separately, but it's now been actually put in the same bucket as other commercial. Currently, in terms of loans which are over 30 days past the due date, mortgages it's only 1%, credit cards 2%, other commercial 1%, and financial institutions 0%. So it's all looking really healthy. The odd one is the loans, which is only a small percentage of the overall anyway, but I'm guessing that's because this includes overdrafts, and obviously a lot of people living perpetually over their overdraft limit, so perhaps that's why. But it's kind of a small number anyway. I did get hold of a commercial real estate number 2022 to 2023. That's dropped, which is good, although it does still seem like a bit of a high number. But the actual overall size of that loan book is very small anyway. So I think it's safe to say that I mean, a lot of people have been pointing at commercial real estate as a big issue for the banks, but based on this information, it shouldn't be a big issue for NatWest. Here I've got the stage 2 and stage 3 presented graphically, and generally it's a improving trend. The only kind of outlier here is retail loans and overdrafts, and we get an insight here that the working class are kind of struggling a bit in the last year or so, but the overall trends kind of look good. Particularly mortgages look kind of safe at the moment. And if there was going to be some kind of housing crisis, you'd expect to see a jump up in the stage 2 first. And so this is something that will be good to look out for. So I've established that the most important factor for banks is the size of their loan book and their net interest margin. And their loan book is generally positive, and in particular, the commercial's been spiking up the last year. Unfortunately, the net interest margin this year has dropped. And this is what I was talking about here, where initially the increase on the long end and the short end was kind of led to an increase in margin, but then as people started paying off their mortgages in response, less people getting mortgages, and then also people shifting cash into deposit accounts, that then led to a lag effect where now the NIM's gone down to actually a low 2%. Now, the last few quarters, it's actually been trending up again, I should say. But still, as of the latest data, that's sort of a negative impact. Now, having said that, the overall number is still better. So it's kind of still a stepwise improvement. In 2018, 2019, it was only roughly 2.0%. So that's not too bad, even though despite this trend. But really, this is something to keep an eye on. It's very important to see the loan book increasing and the NIM increasing if my grand scheme here is going to happen like I've been pontificating. Now I have a look at individual segments of the business, and the retail side, I've got for all these line items presented on the income and expense side. So for retail, it's dominated really by the net interest income. The operating costs dominate on the negative side, so it's nice and easy to understand presented like this. And this black line is the net income. So we see, like this here actually, step change improvement to pre-COVID, but it's trended down the last couple of years, and I've kind of explained the reasons for that. Breaking into the numbers, we see that they did have higher operating expenses, and they said that this was because of higher wages plus investing in the business to kind of modernize it. There was increased impairment losses, which was more assets flowing into stage 3, and we see a lower return on equity and a lower net interest margin for this business segment. Interestingly, there was 1.5 billion more credit card balances, so a bit of an insight there into how the ordinary man is kind of struggling the last few years. The loan book did increase a bit, but a lot of this is because of the Metro Bank acquisition and credit cards and increased credit cards. Sadly, the number of mortgages reduced as people kind of paid off more of their mortgages and less people got mortgages in response to interest rates going up. And then the lag effect of that now hitting us this year. NatWest account for 16% of UK current accounts and 13% of UK mortgages. And they did actually do a 6% headcount drop. And they are deploying this AI engine, which they call Cora, for customer support. And interestingly, that's handling about half of all customer support inquiries at the moment. So hopefully, as time goes on with AI, that's going to again reduce the operating costs of banks, increasing their profitability. Now, the private banking has been performing quite badly, actually, mainly because of the net interest income reducing. And here we see the overall net income trends. Apparently, they've been paying higher wages here too, which affected their profitability. Also, there was a shift to the rich customers that use the private Coutts Bank. More of them, obviously, because of the higher interest rates, storing loads of cash there, which then is bad for NatWest because it means it reduces their NIM. However, although the private banking has done badly, it is only 4% of the overall business, so it kind of doesn't matter. And now the commercial side, and here this gets a lot more other income, and it's kind of half net interest income, half other income. And here they have costs which have gone up quite a lot actually. But overall, this black line's the overall trend, and this is where the banks are really booming. It's in the commercial side. And so this is actually great for NatWest over a lot of other banks, as they have a particularly big commercial segment. Looking at the trends, we see a lovely increase in the total income. Unfortunately, higher wages impacted that a little bit, but the overall operating profit is a great increase from 2.5 to 3 to now 3.6 billion. That's my estimate based on the 9 months data. Their return on equity is looking great at 20%. However, their net interest margin is lower. So it's mainly the increased loan book which has helped achieve this these great results. They account for 25% of business deposits and 20% of lending with UK businesses, and they account for 20% of small and medium enterprises. The NIM has actually been trending up the last few quarters. So looking at different sectors, private kind of doesn't matter, but it's doing the same as retail, and retail has been struggling a bit, but corporates more than made up for it. And I'm kind of generally expecting that trend to continue probably next year. But then as the UK economy recovers from next year, from 2026 onwards, I imagine that we should see retail ramping up as well. And I'm kind of expecting the commercial to continue its current trend. So looking into the history of the bank, and in 2020, they had to stop paying dividends because of events following the Wuhan lab outbreak. And then in 2020, following loads of divestments and things, they changed their name from RBS to NatWest. And they bought 3 billions worth of mortgages off Metro Bank. They'd bought Ulster Bank, and then they actually divested a 4 billion commercial book, and they actually sold 8 billion of loans plus 25 branches to Permanent TSB, effectively exiting the Republic of Ireland. Some good slash and burn here. Now, they lost their CFO in 2022. Then they've lost their chairman this year, and actually their head of their retail business left this year. So a lot of big heads have been rolling, and that's generally, got to say, is a bad kind of a yellow flag. And of course, they lost their CEO, Alison Rose, who was sacked following the Nigel Farage scandal. A bit too much politics with this company. And this, of course, blew up with the Nigel Farage scandal, where the Coutts part of the business decided to debank Nigel Farage. I mean, I can only assume it was because he had the wrong politics. He was debanked, and then obviously that created a massive political outcry. Even worse than that, the CEO actually met with a BBC guy a couple of days before a big hit piece on him in the middle of this crisis, where effectively she divulged personal customer information to the BBC. So she left in disgrace. That is symptomatic of how kind of woke the bank is. They've actually got a KPI of lending 100 billion into green investments, which I don't like, because I think you should be investing not based on political decisions, be lending money to people purely on, are they good to do business with or not? And I think there's a danger here. So highlighting that this wasn't, I'm sure, a NatWest project, but it's an example of this solar panel farm in Wales, which got caught up in a storm. Now, and even like, as you saw there, a wind turbine went down as well. Now, I think it's stupid building solar panels in the UK because, number one, the sun doesn't shine. Why the hell you'd invest in them in the UK where the sun doesn't shine? I just think it's idiotic. And as you can see, our weather's bad. So this is the first of probably many examples where businesses are going to come a cropper. Political activism, such as investing in things like solar panels in the UK. I don't like this political activism about NatWest. That's definitely a negative, which as a key risk, you've got to gulp down hard before investing in this company. So looking at income and expenditure, and I've kind of touched on this already, but we see the big, massive boost in the net interest income when interest rates went up. We had then the lag effect and then the impact of the short end going up, which led to lower numbers in 2024, but still higher numbers than previously. And the net fee and commission and trading have kind of been fairly stable, actually. So this is a great trend here. And what we're hoping for now, like I say, is the short end base rates to go down a bit, the long end to go up, which hopefully, thanks to the government's fiscal indiscipline, that should be an almost certainty with a Labour government. And so we have this nice trend here in the net income, and really I'll be looking for that to further improve, particularly from 2026 and onwards, if my grand scheme all comes to plan. Just a few little odd things to mention. There was a massive boost in 2019 which was related to them actually selling, I guess, the Ulster Bank parts of the business. So that would actually have been a much lower number otherwise. In 2023, we had actually 484 million of FX recycling gains. So that's like a bit of a random anomaly. And so when you factor that in, there's actually then a beautiful trend increase. It's not like a step up and across. Once you factor that in, we've got a progressive increase in net income of 3 billion to 4 billion to about 4.2 billion to then now 4.6 billion when you take account of that. So that's very interesting. It's notable that particularly following all those disposals and things they were doing, generally the admin expenses are down, in recent years. So that's great. And of course, we had these impairments due to the things that the government did following the Wuhan outbreak, and then it's some impairments of those. So that's a bit of an anomaly here as well, which would make these numbers look a bit more normal, a bit more ironed out if it wasn't for that. So actually, yeah, a lot of that's interesting. They posted a net income in 2020, but actually some of those, they weren't actually really real impairments because they reversed them. So there was actually some arbitrage there if anyone had been smart enough to invest in 2020. Income, profit and loss, it's generally fairly steady. By the way, the numbers in yellows are my estimates for the year, and then these purple numbers are the actual 9-month results. And when I look at the graphic I do for that, there is what I look for, which is a nice widening between income and expenditure, and then a corresponding good net income trend. In terms of assets and debt, as I covered before, the main assets are loans to customers and cash at central banks. The main liabilities are actually customer deposits. So that's exactly what you see here. The cash held at central banks and the loans to customers are the majority of their assets. It's notable that there's been a reduction in the amount stored at the central banks as things have relaxed following the COVID crisis. But generally, it's dominated by these two things, and that's another insight into why banks are a lot better now than they were back in the Wild West days. And interestingly, back in the Wild West days, you used to have much more loans to other banks as any asset, and of course, that was a whole part of the reason why the credit crunch happened, because banks stopped lending to each other. And of course, following the reforms, this lending to other banks is a lot less prominent and now doesn't really have any influence on the overall asset quality. Also notable is back in these days there were massive derivatives, whereas now derivatives are a much smaller thing, and you see that the derivatives they have, which are used actually to help guard against interest rate changes to some degree. But whereas at the moment they're kind of, the assets cancel out the liabilities, and they're kind of a small enough number that we can not really have to dig into the weeds too much about them. Back in the Wild West days, you see the derivatives were a huge amount, and they actually had more derivatives than they did loans to customers at some stages. The banks are a world apart now compared with about 20 years ago. You can see that here, where I've put these numbers into a graph, and the assets, it's mostly loans to customers and cash held at central banks, and it looks fairly solid compared with how things used to be. And the same on the liability side, it's now mostly customer deposits. So, and again, this is yet another example where the banks, the quality of the bank's balance sheet is kind of night and day compared with 20 years ago. So why is it that with the bond yields where they are, the banking sector is valued down here? Why isn't it up here when you consider what we can see here with our own eyes? So really, the most important thing to pick out, I guess, is I want to see this loan to customers numbers continue to increase in the next coming year, in the next few years, as part of the grand strategy moving forward for NatWest. Here I've got the market cap of NatWest. We have the loan book in purple, the percentage of their loan book which is stage 2 or 3, and then the green thing here is the net assets. Now I've zoomed in as well here. By the way, the loan book data stopped at 2007, so ignore this bit here. It should actually carry along there like that. But we see that the market cap now is a tiny fraction of the loan book compared with Wild West days. And it's actually, whereas before, if I click on here, the net assets, you'll see that back in those days, which was the times when last time we had, high yielding bonds at the 10-year area, back then they had a much higher market cap to the net assets, whereas now the market cap's actually at a discount to the net asset, and the price to earnings is only 7, which seems quite low when you think of what other stocks are there out there which are bringing in a net income of 4 billion, paying out 5% dividends and 2 billion of share buybacks every year, and yet have only a price to earning of 7. I do think that banks are out of fashion when I look at my market cap visual that I do. Back in the day before, they used to have price to earnings of about 30 and price to books of about 5. Now, we could double the price to book and price to earnings from where we are now, i.e. the share price could double from now, and it would still be looking conservative compared with back here. So yeah, this graphic I do for market capitalization, it does kind of support my base case, and I think it's quite reasonable to expect the market cap to increase to at least meet the net assets. And I've done a very rough estimate what income we can expect them to bring in over the next 5 years. So if you throw that into the mix as well, it seems very reasonable for me to see the NatWest and most of the banking stocks double in the next 5 to 10 years. Now on to the cash flow statement. And first of all, compared with your typical company, this looked just like totally crazy, but I've managed to make some sense of it. The first thing that hit me like a freight train was that their actual net flows from operating activities was negative 17 billion. So forget the 5 billion net income, which is normally the thing that dominates the cash flow. Forget that 5 billion, because that's totally countermanded by this 26 billion of changing operating assets and liabilities, which then completely messes up and ends up with a negative 70 billion from operating activities. Now on the negative, there's also 2 billion of financial flows, and they pay out 2 billion in dividends and 2 billion in share buybacks. And then there's a massive 45 billion purchase of financial assets, which I'm assuming which I'm not sure I understand that, but obviously that's perhaps something that they have some degree of optionality whether they purchase them or not. On the positive side, they have this 5 million of other investment flow, 25 billion on sale of financial assets. So that will kind of obviously negate that. So they're kind of a net negative 20 billion in purchase of financial assets. How the hell do you make sense of this? Well, overall, if this number, they have kind of optionality there, they could have achieved a positive overall number had they not been purchasing financial assets. So I can say that in the first off. The second thing is the actual 2 billion dividends and 2 billion share buybacks. That's actually a tiny proportion of the overall cash flows. So that means it's actually really easy for the bank to continue doing share buybacks and continue paying out dividends for a long time, really, when you consider what a tiny number these are overall when you compare it to the overall cash flow that's going on. Another thing is the total cash. So they actually had 190 billion of cash and equivalents. Through the impact of this change in operating assets and liabilities, that dropped to 160 billion and then back to 100, now down to 118 billion. So it does seem that banks, and it probably relates to their CET1 ratios to some extent, which they're well upside of at the moment of the where they have to be. But I am reading into it that with banks you have this kind of cash reservoir thing where they have so much cash, like as a reservoir, and they're allowed to do various things with their business, drawing off that cash balance as long as it stays above a certain number. They've got a lot of leeway to have negative cash flows from year to year if they want to. So there's that aspect, but I'm going to have to obviously keep a big eye on that. Now, drilling down into what is this change in operating assets and liabilities, we find actually you can have derivatives, but the derivative effects cancel each other out. So it's actually mostly changing loans to customers. So that's where people are paying off the debts, but the banks aren't making up for that by lending new people money. It's bad for a bank to have less people owing them money. That then is a negative cash flow in their change in loans to customers. And then on the asset side of their business, there's a change in customer deposits. So it's bad when people actually deposit more money in their bank, because then that's bad for the bank's NIM, but that actually counts as a negative cash flow because in a bank, customer deposits are counted as a liability. So here we can understand what this change in operating assets and liabilities is, and essentially what's been happening, which is bad, is when you take account of people paying off their mortgage because of the higher rates and less people getting loans because of the higher rates. And then when you take account of more people actually depositing money in the bank, these trends are actually bad for the bank and they're bad for their cash flow. And so this is actually a key risk I think I've uncovered. And so in my checklist I'm highlighting this as a key risk which I'm going to be monitoring. And I'm hoping that this will be like a step change that will start to equilibrate. Just as the base rates have stopped increasing, hopefully this effect will stop happening. And as we see the base rates drop and the long end actually still staying high, but as we see the base rates drop in the next year or two, I'm hopeful that we'll then see a net positive change in operating assets and liabilities, and then that will be turning these banks into total cash machines for shareholders, particularly when you consider how low this 2 billion is for dividends and buybacks versus what kind of numbers we could be looking at here. I definitely want to see this number here staying above 100,000 and trending upwards again. Okay, in terms of the shareholders, for very big companies like NatWest, a lot of the institutional investors don't actually individually have enough of a share for it to register and have to be reported. So that's why there's a great big unknown here, but I'm sure it's all institutional investors. Here we see the HM Treasury own 10%, which isn't something we often see. Norge Bank has 3%, Capital Group 5%, Treasury 3%, and Retail 1%. That's according to my own little calculation I did. Really, trends we see is obviously His Majesty's Treasury has been selling, but that's actually a good thing in this case. Norges Bank, they've actually been selling, which is bad, but Capital Group have come in as a big new shareholder, so that's very positive development this year. So that really completes my look at NatWest Group. As a sector, I think that banks have been out of fashion for a long time, but the actual bond yield situation is returning to something that's actually quite historically normal. The 10-year is going to be back up here like it used to be back in the last time that yields were normal. And I don't think this is really reflected in the banking sector. And I've seen this same trend with all the banks. And so that's why I've been investing in them and why I've invested in NatWest. As long as we're in this channel, I call this my chill channel. As long as I'm in the chill channel, I almost don't even have to think about it. Break out that channel, then I'll have a reevaluation. But yeah, I'm very bullish. The banks, I've looked at the capital ratios, I've looked at the income and expenditure now versus 15 years ago. We've looked at the assets and liabilities composition now versus 15 years ago. We've looked at the credit risk and loans greater than 30 days due, and everything really checks out for me. And if my crackpot theory is correct and we see short rates at the short end dropping and staying high at the long end because the government spends money like a drunken sailor, I'm feeling very positive about my investment into Natwest Group. But some key risks and assumptions that I'm going to be tracking are that I want to see the bond yields revert to a normal curve. It's crucial that house prices don't crash, and that we have a sluggish next year, but then we return to GDP growth, particularly second half of next year and 2026. I've got to keep an eye on net interest margins and the loan book because they're key, critically important. And in the cash flows, we want to see more people getting into debt, not less people getting into debt, and less people saving money in high interest savings accounts, because we want to see the cash flows from operating activities going positive again. So then, based on my analysis of the market cap, how much money we know they're going to make in the next 5 years, I'm looking for a 2x before I next evaluate, tracking that, and I've got my target, and this is how much I've made so far. So I've summarized my check sheet here. You can print screen if you want to read that. And that completes my look at Natwest Group. I hope you find this video useful. I do enjoy doing these videos, and they really help me make sure I've put the proper work in before I do my investments. Remember to speak to your financial advisor though, and good luck with your own investments. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.